Today, we're pulling back the curtain on one of the most powerful and honestly least understood institutions on the entire planet, the U.S. Federal Reserve. So let's just dive right in with a massive question. The idea of completely getting rid of the Fed has been tossed around in political circles. It sounds, well, pretty radical, right? Maybe even impossible. But could it happen? To really get a handle on the stakes, we first need to understand why these kinds of institutions exist in the first place. And you know what? It's true. I mean, besides a few tiny exceptions, pretty much every single country with its own currency has a central bank. They've become this universal feature of modern economies for one big reason. They're supposed to be a backstop in a crisis and put the brakes on economic insanity. But it wasn't always this way. To really get why the Fed was even created, you've got to look at what the United States was like without one. And frankly, it was a mess. You see, the U.S. actually gave a central bank a shot twice before the Fed ever came along. The first one got the axe in 1811, and the second one in 1836. Both times, it was because of political fears that they were just too powerful. This left the country basically without a financial anchor for over 75 years, leading to one period of instability after another, which all culminated in a massive crisis. I mean, this chaos had a real impact on everyday life. Just try to imagine going to a store where they might not even take your money because it was issued by a bank just one town over. With literally thousands of different banknotes floating around, forgeries were everywhere, and just doing basic business was incredibly difficult. And this whole chaotic system, it finally boiled over in 1907. A few bank failures kicked off a nationwide panic. People literally rushed to pull their money out, and the whole system came terrifyingly close to collapsing. The only reason it didn't was because the famous financier J.P. Morgan personally stepped in to bail out the banks. That crisis made it painfully obvious. The country needed a formal, centralized system to stop this from ever happening again. And so, in 1913, the Federal Reserve was born. Okay, so the Fed was created to stop bank runs. But over time, its role got a lot bigger. So let's take a look at how it actually tries to manage the world's largest economy. In 1977, Congress gave the Fed what's now known as the dual mandate. It basically has two main jobs: keep prices stable, which really means controlling inflation, and keep employment as high as it can possibly be. Now, the really crucial part here is that these two goals are often pulling in completely opposite directions. To try and achieve this balancing act, the Fed really only has two main tools. And the easiest way to think about them is like the pedals in a car. Interest rates are the brake pedal, used to cool down an overheating economy. And then open market operations, well, that's the accelerator, used to give the economy a boost when it needs it. Let's see how that brake works in practice. So when the Fed raises interest rates, it gets more expensive for everybody to borrow money, whether you're a family buying a house or a business trying to expand. At the exact same time, it becomes more rewarding to save. The result? People and businesses spend less, which reduces demand and, in theory, brings prices back down. The accelerator, as you can probably guess, works the other way. The Fed buys assets, usually government bonds, from banks. This pumps brand new money into the financial system, which encourages banks to lend more and get the economy moving again. During extreme crises, this gets the fancier name quantitative easing. So that's the theory, but here in the 21st century, the Fed is up against a set of problems that its founders could never have dreamed of. And that's making its job way harder and a lot more controversial than ever before. You might be surprised to hear this, but for most of its history, the Fed was actually a huge moneymaker. Because it can create money out of thin air to buy things that aren't interest, like government bonds, it usually made tens of billions of dollars a year, which it then handed right over to the U.S. Treasury. But today, that is completely flipped on its head. See, during the pandemic, the Fed bought trillions in bonds that pay very low interest. Now, to fight inflation, it has to pay high interest rates to banks on the money they keep with the Fed. So it's paying out way more than it's taking in, running huge losses. Now, economically, this doesn't really matter. It can just create the money. But politically, it's a huge problem. It makes the Fed look mismanaged and incompetent. Another massive challenge is debt. We're talking about debt levels for regular households, for big corporations, and for the government itself, all sitting at or near historic highs. This makes using that brake pedal incredibly risky. Even small bumps in interest rates can cause devastating ripple effects across the whole economy. And this leads us to one of the biggest criticisms of the Fed today. Its policies of super low interest rates and quantitative easing have pumped trillions of dollars into the economy. But that money hasn't gone to everyone equally, not even close. It has overwhelmingly flowed to wealthier people who own assets, things like stocks and real estate, driving up their prices and making the wealth gap dramatically wider. All of this brings us to the central conflict of our story, this growing battle between the independent central bank and the elected government, who, right now, want completely opposite things. Right now, the Fed's number one job is to fight inflation. And to do that, as this slide shows, it needs to hit the brakes and hit them hard, raise interest rates, slow down the economy, and crush demand. But at the exact same time, the government is doing the complete opposite. It's pushing expansionary policies with really high levels of spending and major tax cuts. They are slamming on the accelerator. This quote just perfectly captures how absurd the situation is. You have the two main drivers of economic policy locked in this head-to-head battle. The Fed is desperately trying to slow the car down, while politicians are flooring it. This whole conflict puts immense political pressure on the Fed to just give up its inflation fight. And if you're wondering what happens when a central bank loses its independence, well, we have a very recent, very painful example. In Turkey, the president forced the central bank to keep interest rates low, completely against its better judgment. The result was as predictable as it was disastrous: runaway hyperinflation and a currency crisis that the country is still reeling from. Now, the good news for the Fed is that it was designed on purpose to resist this kind of pressure. It's not just one building in Washington, D.C. It's actually a whole network of 12 regional banks. That decentralized structure makes a direct political takeover really, really difficult. So it all boils down to this fundamental question of governance. Who should be driving the economic car? Should it be independent experts, technocrats, who are shielded from politics and focused on long-term health? Or should it be the politicians we actually elect, who are supposed to be responsive to what the public wants and needs right now? As the Fed faces all these unprecedented challenges, from its own shaky balance sheet to a government that's pulling in the opposite direction, the fundamental question remains: can long-term economic stability and short-term political demands actually coexist, or is some kind of major collision simply inevitable? The answer to that is going to shape the future of the entire global economy.